welcome everyone to the February meeting of Left Field Investors. I'm glad that you are here. Just a couple of things I wanted to say. We are growing super fast, which is great. We have our regular Left Field Investors group that you all are a part of. And then we also have our infielders group, which we launched just about 2 weeks ago, I think. And I'll mention that in a minute. Next Sunday is our launch of our podcast, which is Passive Investing from Left Field. I think I'll send it out again tomorrow, the preview. And when the actual podcast launches or before, it would be helpful if the Left Field Investors, if we could all go and give it a 5-star review and subscribe, just so we can kind of get some traction and get some more people interested in our group. Also, a reminder, when you're talking to sponsors, make sure you're mentioning that you're a part of Left Field Investors, because we are finding that, there's some sponsors that are going to give us lower minimums and some other possible perks for our group. But we're not going to get that if they don't know that there's, multiple people calling them up. So please remember that. Then Kenny Wolf, a syndicator who several of us are in deals with, he is coming to Columbus for those of you that are local on March 23rd to visit a property. And if you are interested in seeing Kenny, let me know, or you can also let Chad know. And I don't think Chad's here tonight, but just let us know and we'll give you the information for that. And then finally, the infielders, just for the reminder, there's an invitation. All you need to do is go on the website, the infielders login to subscribe. It's $99 for a year. And that gives you access to all the tools that we've been talking about, the deal screener and deal analyzer and some other things. We are working on the deal tracker, the portfolio tracker, which I'm really excited about. And that should be hopefully done in the next few weeks. We'll see. Like I said, $99 for the first 50 members, then it'll go up to $199. Just to give you an idea of what's going on there right now, we've had over 250 posts on 34 different topics in the forum. So the forum's really getting rolling, which is exciting. March 15th, I haven't sent this out yet, but March 15th, we're going to have a infielder meeting on Zoom, and we're going to discuss the downsides of share classes and preferred equity in syndications. We're also going to talk a little bit about sponsors. So if that's something of interest, go ahead and sign up for the infielders. And then we're going to get rolling with Jeremy Roll here in a minute. That was not on purpose. If you want to ask Jeremy a question, because this whole thing is going to be question and answer. So if you have a question, rather than stumble over ourselves with the Zoom, just either, if you know how to raise your hand on the, not like this, but with the little hand there, you can do that. Or if you can just put a note in the chat that you want to ask a question. You don't have to put your question there, because I want you guys to ask your own questions, but just say that you have a question, and then I'll call on you. That way we're not stumbling over each other. And Jeremy, just so you know, we typically go to about 8 o'clock. So as much time as you want to spend with us is fine with us. And we will, time permitting, do our networking afterwards, where we're going to break it into rooms of 5 or 6 people. And then you can kind of get to know people on a more personal level if people want to stick around for that. So brief introduction to Jeremy. He started passive investing in 2002. And in 2007, he did what all of us want to do, which is ditched his W-2 and became a full-time passive investor. He's co-founder of 4 Investors by Investors, which is a group that sounds very similar to what ours is on a much bigger scale, but he facilitates networking and learning among real estate investors, which is one of the things that our community is trying to do. It's now the largest group of public real estate investor meetings in California, with over 30,000 members, which is amazing. So thank you, Jeremy, for coming. Really appreciate it. I'm going to get my question out of the way, and maybe you can, add on to a little bit about yourself and then answer the question. If you can talk a little bit about kind of what you forecast for 2021 in the passive investing space, and also maybe your favorite and least favorite asset classes for 2021 and beyond. So welcome, Jeremy, and I'll let you go from here.
Thanks, Jim. I appreciate it. Thank you for having me here. Please don't hesitate to ask any questions. I'm happy to field anything, and I'll certainly say if I can't answer it. Jim, I want to plug a topic actually you just mentioned in your upcoming meetings, which is the preferred equity. For those of you who don't understand what that is or have looked at it and have considered even invested in it, but haven't, or I don't know. I just know that a lot of investors don't really understand all the angles there. When I talk to them, it's been a topic of discussion, and I've had a lot of investors for the past probably 2 to 3 years. I would strongly recommend attending that. I don't even know what Jim's going to cover, but I just wish more people understood it thoroughly, because I do find some people don't even understand it fully before they invest in it sometimes, and it's just not a great thing. So I am not an investment advisor or financial advisor, accountant, or attorney. So anything I'm saying here is just my perspective as an investor. That's an important point. Let's see. Jim, do you want me to give more information about my background, or do you want me to just jump into those questions you had?
Well, yeah, maybe just a little bit about your background, if you don't mind, just for a minute or two, just to give people a little bit more than I gave, and then
Sure.
jump into the questions, if that's okay.
Okay. So I've been investing passively, so in syndication, since 2002, and I really got into it as a response for myself to the dot-com crash. And for me, it was about not really, I got really turned off after the dot-com crash due to a combination of the volatility in the stock market, which I'm a really low risk, slow and steady guy, and just the up and down 30% in a year, up and down, it just wasn't a good fit for me. But more importantly, it was a really lack of predictability of the long-term retirement account for myself and that strategy, and just not knowing where that retirement account would be in 10, 20, 30 years as a result of all this volatility. That was really what kind of had me look at more syndicated investments. And I tend to focus on the lower risk, more predictable cash flow type spectrum, where I really got into this because of the lack of predictability and looking for more predictability. And so I've been investing in that profile of or type of deal, 99% focus, since 2002. Cash flow got me out of the corporate world back in 2007. And I guess the way I describe myself now is I just want to continue my cash flow stream going and my snowball growing so I don't have to go back to the corporate world. So that's my number one concern, right? What else? I'm originally from Montreal. For those of you who are on the East Coast and cold at the moment, I spent half my life in snow, so I can completely relate. Trust me when I tell you. I'm now in LA. I've been in LA for the past, I guess, since 2000. So I guess it's about 20, 21 years. What else? I do manage an investor group, a private investor group. We have over about 1,500 investors. That's separate. It's something I don't normally get into very much. I'm very low profile about it, but that's at least part of my background. And I'm also an advisor for Realty Mogul, who's one of the largest real estate crowdfunding websites. I've been an advisor with them since before they launched back in 2012. And I'm honestly involved in a lot of things, even outside of real estate. I'm in a handful of startups. I am in ATM machines, a little bit of oil and gas. But my favorite and primary focus is what I would call low risk, diversified tenant base, experienced sponsor. I say commercial real estate, but what I really mean by that, it could include apartments, student housing apartments, and mobile home parks, and all kinds of stuff. Just more the idea that's a bit more at scale, right? So that's my background. Sorry, it was a little long. And so just remind me again. So first question you had, I want to make sure I really address it properly.
Yeah, my question, well, a two-part question. One is kind of what do you see for 2021, kind of the outlook for some of the assets that you invest in? And then what are your current favorite and least favorite assets to invest in, not only for 2021, but maybe for the next couple of years?
Okay. And I forgot to mention one more thing in my background, because I know there's some East Coasters here. So I did an MBA over at UPenn or Wharton, for those of you who live in Philadelphia or were near there or whatever. So I was there for a couple of years in Center City. 2021 for me is a year of discovery and sideline sitting for the most part. I know that's kind of probably a very boring answer, but the reality is that I feel like with what's going on with government intervention, that until the government intervention subsides for the most part, and what I mean by intervention, I don't just mean money printing. I mean eviction moratoriums. I mean like literally rent subsidies, for those of you who aren't familiar, from local and state governments to some apartment renters and landlords. I mean mortgage deferral and abatement and everything else that's been happening as well. I really want to see what happens when all that goes away. And when I say all that, I mean for the most part, right? So there could be ongoing stimulus, truly ongoing of some type, but the vast majority of all this trillions of dollars in money printing will come to an end. And the question is, what will that look like when it comes to an end? You know, what effect will the eviction moratoriums lifting have on occupancy rate in apartments, depending on which types of apartments and which locations you're in, right? And what does that mean necessarily for the net operating income of a building in a year from now versus today? If I'm going to consider something now versus a year from now. So because I'm really low risk and I'd already positioned myself for end of cycle between 2017 and 2020, I've been mostly on the sidelines for that time period. And I say mostly because I'm always doing deals, but it's just a lower volume than I normally do, which is probably too many. I'm in a lot. I'm in over 60 LLCs right now, and I've been over 30 to 40 sales in the last 3 years, probably 4 years. So, but I'm philosophically on the sidelines waiting to discover what happens once all this artificial environment is gone, or most of it, because I feel like we're probably not going to have that much longer before we discover that, meaning I don't see them printing trillions of dollars next year necessarily compared to this year. And if that means we have to wait 12 or 18 months to discover what this is going to look like, that's not really very long in the realm of real estate investing and the bigger picture of a bigger cycle, right? And the biggest challenge I have right now is that the end of the cycle and the beginning of the next cycle, that has been delayed by this money printing. You know, if we wouldn't have had all this money printing in 2020, we probably would all agree that we'd have a massive reduction in asset prices, a massive increase in vacancies across all asset classes. And the new cycle would have probably began to start already. But the government has delayed the beginning of that new cycle. And we need to know what it looks like getting into the new cycle so we know where to start from with the new cycle. Because if you think about a cycle, we normally start low and get higher. But we need to know where we're actually going to start from. At least I think I need to know where I'm going to start from to make educated decisions on what I'm going to invest in right now. So that's the challenge. So when you ask me my favorite and least favorite asset classes for this year, I can tell you my favorite asset classes, or at least what I'm trying to target, is anything where I don't have to worry about the value of the building going down, or the value of the asset, I should say, going down in the next 12 to 24 months while I'm waiting for this discovery to happen, because there's that risk. And something for me that's got more predictable cash flow in general. And so I'm going to use some examples because most of them probably won't be real estate, but I invest in ATM machines. They depreciate to zero. This is a fact of life, right? After 7 years, they're worth almost nothing. And so if it goes down in value in the next 12 months, I don't care. Literally don't care, because I'm expecting it, right? What I care about is that the cash flow stream is not going to be interrupted, and it's going to be predictable, and it's going to be there, right, within a certain range. And so that's a good example of something I'm investing in more right now, because I don't have to worry about the asset value going down. I don't have to worry about the economy getting a little worse, because we've been through probably the worst of it from a retail perspective. And even if we haven't, it's already performed reasonably well, depending on which retailers you're in with. If you're in with more, what do they call them again? I always blank on the name. Essential retail, stores. And so I have the risk reward there is pretty good from my perspective. Anything that can mitigate downside value protection right now, or something short term. So I'm doing a little bit more hard money lending this year. I kind of put a stop to it last year, just turn it back on. In fact, I just sent a wire in a few hours ago for several hard money deals. And to me, the reason why that's appealing, so all the money printing, if I'm going to get my money out in 6 to 12 months, the next 6 to 12 months are probably quite predictable as a result of the money printing. What's not predictable is, 6 to 18 months or 12 to 18 months after. So I'm trying to leverage what I know is happening this year to an extent without exposure beyond that if I can. And then there's the odd, unique deal. Like I'm investing right now in a low-income housing tax credit apartment deal. And for those of you who aren't familiar with it, it's definitely complicated. And this particular deal is...
Can everybody mute if they're not talking? Thank you.
Thank you. So what's unique about that deal is that, we're buying it directly from the state of Texas. There's very specific concessions being done. It's a very unique situation as far as like the rents are already pre-decided by the state for 2 years out, right? So we have no rent reduction risk for 2 years. The asset value is based off of the rents, not off NOI in the way that lenders value it. So there's not really very much risk in the value of the building going down very much. And we're also going to have, we're at 25% below market rent. So even if rents go down, we're really well protected. And it's a 10-year hold, and it's in one of the best locations in Dallas. And so you could tell, I'll do something unique right now if I think it's going to protect a lot of angles, but I'm not going to do something that's just, here's a 5.5 or 5 cap or 4.5 cap multifamily deal in a certain location. I'm just not comfortable with it myself. It doesn't mean it's not going to be a great deal. It doesn't mean whoever invested that today won't get great cash flow out of it. And frankly, it doesn't mean that the person who invests in that isn't going to do better than me in the long term, because I swear by the fact that anyone who's constantly got all their money at work versus someone on the sidelines is going to do better in the long term, and that's not me. But it just doesn't fit with my personality correctly at the moment. So 2021 is an odd year where I'm just trying to kind of like make things work and find things that could work based off of them being unique. If there's a quick payback, if I'm not worried about asset values going down, if the cash flow appears to be predictable, I'll probably take a good look at it. But a lot of real estate doesn't fall under that necessarily.
Okay. So I guess I think, Sean, you have a question, but real quick, just to follow up on that, Jeremy. So if somebody is just starting to get into passive investing, you're not saying wait until 2022. You're just saying different risk. You have a different risk appetite maybe. And it's not that it's bad to invest now. It's just you have other places to put your money rather than multifamily or some of the standard things some of us might be doing.
Yeah. And, it's, I find it very subjective, right? Because nobody, like you have, when you're investing passively, everything's got to be the right personality fit for you. One person may be investing in development. I've never done a development deal in 19 years. And that person may say, you're crazy doing stabilized because I'm going to outperform you in the long term. And they're probably like actually correct, like numerically, but I'm not comfortable with it, right? So there's a lot to do with comfort level. And I think, let's say the thesis of going into a regular average apartment building today, even if you're okay with the value of the building going down and coming back up over a 10-year period, you've got a locked in 10-year loan, for example, and you don't care if the cash flow goes down a little bit, but you want to put your money to work. But in 10 years, you're going to be in a good place because asset values typically go up over time. Like that's a great thesis. And I completely understand that, right? It's just not what I do personally because I prefer to wait the year and just see what happens.
Okay, that makes sense. So I'm going to open up for questions for anybody. I think Sean is going to lead off, but if anyone has a question, I see one in the chat. So Alan, we'll get to you next. But yeah, just put a comment in the chat that you want to ask a question, or raise your hand, and we'll just I'll keep an eye on the chat and I'll call on you. But we'll start with Sean. Sean Donnelly, go ahead.
Hey, Jeremy, thanks for your time this evening. And it's having you on here and asking this question, I think is pretty relevant, because one of the things that we talk about in this community is what's the right number of investments? Is there a number that's too many? Is there a number that's too small? And to hear you say that you're in 60 different LLCs certainly has, I think, some people's heads spinning on this call, especially those that are in our community that maybe haven't even gone into their first investment yet. And so they're sitting there saying 60, wow, that's a lot. So I know it's probably a different mix for everybody, right? But in your mind, 60 too many, 60 is the right number. Like, how do you go about evaluating if you're in too many or not?
Yeah, great question. For the record, I do not recommend what I'm doing whatsoever. It causes, I have a constant like in and out. I have to check just so many balls up in the air. I happen to like it because, I do it full time. And once you do it for so many years, you have so many things come back. You eventually diversify. So that's kind of what's happened. So I would say the most common amount of diversification that I see in discussions with people, because it's a very subjective topic, is typically 10 to 20. If you ask me, what feels most right to me is probably 20, if it were my money. And let's say I couldn't do this full time or didn't have an interest in being more diversified. I get very nervous below 5 to 10, like even below 10 for myself. I get like just the thought of doing that and carving into 10 would make me nervous. And I'm also on the low risk kind of scale of the spectrum. So, I'm already biased, but I'd say 20 would be my personal preference if I could. But I want to be clear about something too. Like, it's very difficult to optimize in this space, because the problem is, like, you're not going to the supermarket and saying, I want to buy an apple and I'm just going to pick one of 100 in this pile and I'm going to, leave the store and it'll be done. The challenge is that I never know when something's going to come up that makes sense to me, right? And especially not because I'm not just looking at multifamily, I'm looking across all asset classes, trying to get diversified across asset classes, geographies, and operators. And so it's really tricky because you don't know what you're going to find in the future. So I think having the goal of 20 is great. If that means you get to 15 or 25 or 18 or 22, I think that makes a lot of sense. But I want to point out to people, it's very hard to optimize. And it's also, if you're brand new, to Sean's question, it's very, you can't say to yourself, okay, I'm year one, I have this amount of money sitting here on the table and I just want to get into 4 deals. Like, you might get into 4 deals, but what happens if you don't find 4 of the right ones, right? You shouldn't force it. So you got to keep all this in mind as you're trying to get diversified in this space, because you can be proactive in trying to build the biggest network you have, but in the end of the day, you're being reactive to what you find. And that's a very important point in trying to figure this out.
Excellent. Thank you.
That's great. Thank you.
Alan, I think you have a question.
So Jeremy, thank you for coming on this evening. You said you were pandemic resistant businesses and that you'd focus on those. Do you evaluate risk based on class of property though, where class A's are less likely to be pandemic impacted versus the class C's where they're having a bigger challenge?
Yeah, great question. So, you know, it's funny. Oh man, it's crazy that we're even talking about this, but I invest to try to avoid challenges like a recession. So I invest with recessions in mind. I don't invest with pandemics in mind, truly. Like, no, I don't think anybody does, right? And so I describe more what I try to do is figure out what makes sense from a recessionary perspective, because everything's cyclical and recessions happen, right? So it's going to happen. And so I've always targeted Class B. And the reason why I've always targeted Class B is because Class A has exposure during a downturn, in that some people have to downsize jobs, other things happen, salaries come down, and the rents will come down with all those. Class C, it can be a challenging asset class just to begin with, unless you have a really good manager, because you're already at a point where the predictability of cash flow is a little tough, even though the typical cash flows are higher, because collecting on the rents is much more difficult in a Class C than a Class B or Class A, if you're talking about like a true Class C. So for me, the run-of-the-mill middle point where Class A can trickle into Class B. Class B can take a hit during a downturn, but it's typically going to be, you know, a blue collar and maybe even slightly white collar type of crowd. But someone who's going to be easier to collect from is maybe trickling down in a recession from the Class A to Class B. And there's going to be some movement from Class B to Class C, but I'm not going to have to worry about collections as much, which is a problem for my predictability. So I've always liked Class B. I've always targeted Class B, and I continue to do that. Honestly, this is very subjective as well, right? There's a case to be made for every single one of those, depending on your own opinion. So that's just where I happen to land.
Thank you.
Okay, Mark Shooter, I think, has a question.
Hi, Jeremy. Yeah, thank you again for taking the time to speak with us. So I think I had heard you say in a podcast recently that you spend about 3 hours a day, or try to at least, and kind of focused reading. What are your go-to resources when you read?
Yeah, sure. I'd say I do probably like 2 to 3 hours. It'd be really rare, unless I was off that day, it'd be really rare if I didn't get at least 2 hours in. So I try to read a balance between what I call mainstream media to understand what is going on as far as consumer perception, consumer sentiment, and everything else, along with stuff that's not quite as mainstream that helps me to get more into the data and a little bit more objectively, hopefully. So the mainstream stuff, I look at CNBC. I really like that. I used to look at Business Insider, but during the elections, and I don't even vote, I'm just a disgruntled, like, against all politicians bias. But the point is that, like, you know, Business Insider is great because it tends to be it just covers all different topics, but it got so political, and like half of what they were covering was political, I guess, to try to sway the election, that I just got fed up. I don't know what it's like today. But you can maybe check that out. I happen to like Drudge Report only because it's an easy place to click off of links, and it's one of the 10 most trafficked websites in the US, so you can get a sense of what people are reading. It is, I think, politically biased. It's changed over time, but I still like it because it links off to other articles, and those are mainstream articles anyway. Those are like the first three. And the thing is, when you start pairing, and by the way, I also pair off of like a Google feed on my phone that feeds me articles based on what I view. So between those four, I'm already getting a lot of different articles because I'm pairing off into other articles and other sources and stuff. The ones that I recommend that are less mainstream. So the first one is, if you want to just look at the data released on a given day, whether it's jobless claims or whatever it is, I'd recommend going to calculatorriskblog.com. And you can read, they do kind of publish a little bit of an opinion on stuff, but it's more about the charts and the data. What I really like is what they do is they'll take the data, but they'll actually put it into an objective chart. You'll be able to look at the chart going pretty far back and just at a glance see what the hell's going on. They tend to be slightly optimistically biased, I think, but they're not bad. And so that's a really great place to look at, instead of reading the CNBC article that's trying to interpret it for you where it might be biased, you can just look at the chart and all the previous data much more objectively. I really like zerohedge.com. That's a crazy website in that like 75% of what they post can be considered conspiracy theory. But the other 25%, if you could just weed it out, is and maybe only 50 or 25, I guess, depending on your opinion. But the other 25, these guys are Wall Street veterans. They started in 2009, right after the whole housing crash, and they really get into a lot of the data and slice it and dice it in ways that you and I wouldn't realize. Like, you can read a headline on CNBC that slants the data one way, but then they get into a different way, and like, you can understand that jobless claims went down or up from something that someone didn't point out that is really important, but the mainstream media just isn't paying attention to it because of a certain narrative, for example. So I really find they do a good job of getting into the thick of analyzing some data, and actually some articles that are very forward thinking as well, whether it's inflation or other stuff. Another one I really like is shadowstats.com, shadowstats with an S.com. What that website does is it takes, like, for example, inflation, and every time there's inflation published, it'll actually republish it in several variations based off the way the government used to calculate it. And so if you want to see what quote unquote real or closer to real inflation is, you can go on there, and they'll look at the pre-1982 calculation, which is probably one of the most accurate, because over time they very conveniently change the mix of things they're looking at to make it seem like there's no inflation when there's really inflation, right? Because they're underweighing education, housing, and other things on purpose for their own purposes. So that website kind of puts things back to normalizes stuff, and you can really get a better sense of what's going on. And one thing I would point out is, I know some investors, and even myself, I'm not that hardcore about it, but there's some people who look at the measure of inflation on shadow stats and say, look, I've got to beat that number if I'm an investor. And it's not like 2 or 3, it's going to be like 6 to 8, used to be 8 to 12, back in the last downturn. And they'll specifically target their investments to make sure they're staying ahead of what they consider to be the real inflation as opposed to the published inflation, just as a general mindset. So those are some websites, just as quick examples that are good. There's a lot of other ones out there too, but those are some of my favorites.
That's great. Thank you so much.
Okay, Waleed, you're up.
All right, Jeremy, thanks again for presenting. Just 2 quick questions. One was about when you're kind of looking at the sponsors. I know we're standing at the sidelines right now, but I'm wondering if you've ever had a chance to see if the sponsors are actually looking at the tenants and what % of the tenants are receiving like subsidies. Because imagine that would be a useful thing to know going into a deal, given that at some point those checks are going to stop coming in, and there's a chance that, you may not be. Now, that may apply only for Class C properties or maybe even D properties, but just something I'm wondering if you've ever come across them doing that during due diligence. I know they can't do it beforehand, but just a thought. And the other question I had for you was, you talked about other deals that while you're waiting on the sidelines regarding multifamily, other opportunities. How do you find those?
Yeah, good question. So I'm really glad you brought up the topic of rent subsidies, because I don't think a lot of investors understand what's really going on behind the curtains right now. So there's so much money chasing deals still that I've talked to a whole bunch of sponsors about this. There could be 10 or 20 bids on a building. And what's happening is that if somebody goes in and even starts asking about how many of your tenants are getting rent subsidies, what does that look like, and then tries to negotiate it, as soon as they try to negotiate it, it's done. They're just going to move on to the next offer. So that's kind of where we are with exuberance in the market today. And it's not just real estate, it's just across the board. So that is actually one of the reasons why I prefer to sit on the sidelines, because sometimes the buyers cannot get that information, and sometimes they can get that information, but they can't do anything with it. And so, meaning they can't negotiate it. So you just have to assume that you're taking that additional risk as an investor. And what bothers me about that clearly is that, let's say a building has 10% rents being paid through subsidies, which is actually fairly common from what I've heard around. Let's just say half of those tenants end up leaving, just a random half number, right? So now you've kind of overpaid by NOI by a certain amount for that building, right? Forget whether cap rates adjust on top of all that and everything else, right? You've now overpaid for the income in that building that won't be there in a year from now or half a year from now. And that's fundamentally one of the several reasons why I'm on the sidelines. So thank you for bringing it up. As far as, well, I'm blanking on your second question. I'm really sorry. I think we may have.
I think he's frozen. He was asking, what are you're not really looking at the multifamily now. So what are some of the other assets?
How am I finding other stuff, right? So
Yeah.
thank you. Sorry about that. So I have an advantage, and the advantage is I have 19 years of networking. You know, and I say advantage compared to someone who doesn't have 19 years of networking. And so some of the stuff I've done has been very proactive. Like when I first started and I wasn't married, didn't have kids in LA. LA is a big city, and I was going in like 2002 to 7. I was going to probably 2 to 3 meetings a week, right? Real estate meetings around town here. There's just a ton of them. And I built up a network as quickly as I could. This is you know, if you think about it, it's kind of like still early internet and pre-community and pre-smartphones and everything. And then I actually co-founded my own meetings to help people to unite in an environment with no sales pitch. That's the core foundation of For Investors, By Investors, why we're a nonprofit. But what ended up happening is I ended up with a lot of benefit from a networking perspective, just because I was the co-founder. It became you know, significantly large, and I was one of the 2 co-founders, so just kind of got a lot of networking. One of the reasons why I have my own investor group is from a networking perspective too. That's tremendous. And every time I go into a deal, one way or another, I always trace it back to networking because of the nature of these deals, for the vast majority being private, and certainly were private until a few years ago, until they had the 506C structure. So the key is networking. And I just happen to have so many years now that I get stuff coming to me all the time, even outside of real estate. And, you know, that's kind of what happens over time. So it's kind of a boring answer, but that's just the reality.
Okay. Next, Nick, I think you're up next, and then Brian.
Hey, Jeremy, thanks again for coming on. It's really great to have you. A couple of two questions. One is with regard to your view on kind of sitting on the sidelines for the next 12 to 18 months to see how things shake out when subsidies start rolling off and government intervention. How do you think about and I'm not saying I agree with what the government's doing, but for better or worse, they're doing it, and they've kind of, not only the U.S. Fed and Treasury have kind of signed on to this playbook since 2007, 2008, but central banks across the world, where they're intervening artificially to support markets, and it seems like this is the playbook. And again, I'm not saying I agree with it, but it doesn't seem like they're going to step off the pedal. I mean, to the extent that I'm involved in the junk bond market, and they're stepping in and throwing billions of dollars and buying junk bond securities, which they've never done, just to support markets. So I mean, do you think that maybe in 12 to 18 months that this cycle is just not gonna, like, are they ever gonna take off the Band-Aid and let the markets go through the cleansing of pain and bankruptcies? I mean, it seems like they're bailing out anything that needs help however they can, and throwing anything they can at it. Yeah,
good question. Well, you know, when I'm talking about the government intervention, I'm focused more on direct consumer payments, checks, subsidies that are impacting consumers directly. Buying all those assets, mortgages, bonds, and everything else, that's a different story and has a different impact, I think. But I think the reason why I think that we're going to see an eventual reduction in the government interventions I'm talking about is because at some point the economy is going to get significantly better, and they're not going to be able to just continue on and to be able to substantiate the additional money printing from that perspective. So I think there's 2 different sides of it. If you ask me if the quantitative easing, so to speak, or the purchasing of all those assets is going to stop, I'd say probably not. They really can't. They can't afford to. They can't afford to have the whole thing collapse. So I think that's probably going to go on. I think we're down a road significantly enough that it's just going to get worse over time. And what I mean by that is, you look at Japan, which is a great case study for us, starting in the early 90s. They own over 40% of their own stock market, if you can imagine that, right? The government. So, and that's been the result of keeping everything propped up. And it's just like the junk bonds, but it's like the next iteration, right? So I think we're eventually going to get there. You know, I'm honestly concerned this will be our last normal cycle of growth where we can depend on positive GDP growth going through an entire cycle. And then how that impacts us as investors beyond this next cycle eventually. I'm a little concerned that cash flow investors are going to end up in a position where the interest rates are so low and the cap rates are so low that we're going to have to depend more on the appreciation of assets through the quantitative easing purchases and asset price inflation, as opposed to cash flow, because the cash flow levels are going to get so low versus actual inflation, the real inflation. that it's going to be a real big challenge. But I'm trying not to worry about it too much until after this next cycle, which is probably 10 years from now. But that's my biggest concern right now, if you ask me, if anything, is this, I think, is my last normal, reliable cycle of predictability for cash flow that I could probably depend on.
And then the other question just revolves around logistics of investing. Are you investing in all these 60 or 70 kind of LLCs through your own LLC or in personal name? And then secondarily, are you trying to manage tax efficiency in any way? So like say if you have an investment coming due this year, are you looking to buy something else that has accelerated depreciation to kind of offset the big gain?
Right. So first thing I'll say is like almost 20 years now, I've asked a ton of attorneys and accountants about this question, and I've never gotten like a solid answer. But what I've always gotten from accountants is, you're getting the flow through of depreciation and expenses, and so it doesn't matter, right? Whether you're investing from a corporation or personal, and you're getting the attorneys say, well, you're a limited member, right? And so you're limited to the amount you initially invested. You're not exposed to potential lawsuits. Those are the managing members. And so you're not really exposed from a legal perspective, whether you invest personally or through a company. Again, I'm not an accountant or attorney. I'm just telling you what I've been told. So I've just, for the most of the stuff that I do, I invest personally. I just can't, I've never found an argument that it actually makes a difference. No one's ever, like in all this time of all the conversations, I've never heard a reason. Now, estate planning, trust and all that, that's a different conversation. But the fundamental, I've never really gotten a good answer as to what, that it would make a difference. As far as whether I try to optimize taxes. So I am not one to invest for tax purposes. I'm one to invest in a deal that I think makes sense from a cash flow perspective. And if it has tax benefits, great. But that's, to me, is icing on the cake, because I'm always concerned that tax laws can change. And so I'm not hell bent on optimizing my taxes every single year. That being said, a lot of what I invest in has depreciation that accompanies it. And not necessarily year one, but in general. So a lot of my income is deferred in terms of taxes as a result of the depreciation and the expenses offsetting either most or all of the income. And I do get some benefit of even negative income, so to speak, or a loss, than shielding some of the other income. But I'm not optimized. I don't have an optimized strategy. Like I optimize for cash flow, not for the taxes.
Thanks, Jim.
Yeah, no problem.
Okay, Brian Meyer.
Hey, Jeremy. Can you talk about all the different types of asset classes that you invest in, and maybe give us a feeling for the weighted average within those? It sounds like you're in a lot of different types of investments, but I heard you say mobile home parks, you've talked ATMs, you've talked a lot of commercial real estate. Can you kind of give us a weighting, and if that's on purpose or if that's just kind of where you found yourself over time?
Yeah, so I don't have an exact numbers for you, and I'm in a lot of different things. I'll give you a quick list, but the bottom line is, and the important part of the answer, I think, is that if you're trying to diversify across asset classes over time, and you can take the time to learn each one, then you're again going to be reactive, not proactive. You can't say to yourself, like it isn't an Excel spreadsheet. You can't say to yourself, I want to be in 3 mobile home parks, 4 self-storage deals, 5 apartments, and 2 offices in the next 24 months. Because again, you're going to be, in my opinion, you're doing it the wrong way around, even though theoretically it sounds like it's the right way around, right? Because that's going to force you to find deals where you may not really be comfortable with specific deals, right? What I do is I just take what comes to me, filter it, and have an opinion about which are the best asset classes for the next 10 years for me, and go with that. But I didn't back into a spreadsheet to say I want to be in this and this and this and this, because I don't think it's realistic, to be honest. And I'm concerned that if anybody does manage that, then either they've done like the best networking in the world, or they've kind of forced some deals, into it, which I think is really not a good idea. The only things I'm not invested in are hotels and industrial. I've been in some industrial in the past, but I haven't done some lately. And I'm in even like single family, hard money, right now hard money, but in the past, and I will do at the beginning of next cycle, probably flips, buy and holds, hard money on those. I've been in some notes, mobile home parks, self-storage, RV parks, apartments, student housing apartments, office. I'm in office, retail strip centers, even in retail enclosed mall in Canada. I've been in industrial. And then I'm in like ATM machines, oil and gas, about 10 startups. And I'm even in something called debt validation, which is kind of like debt consolidation. So there's just all kinds of stuff that I'm in. It's really hard for me to break it down for you.
Okay, Ryan Stieg, I think, had a question.
Yeah, hey, Jeremy. So when Jim was introducing you, he talked about you as the passive income guy that kind of we all want to get to. Can you talk about how you strategized to get to the point where you knew you felt comfortable that you were at that point? And then since then, how do you balance the cash flow that needs to be redeployed to make it sustainable versus what you need to live on?
Yeah, good question. So first thing I'll tell everybody is that I did not say to myself in 2002, you're going to take X number of years, deploy X amount of cash per year and get to this, endpoint. I actually see people do that, and I love watching people. That's not what I did. I planned on staying in the corporate world and just getting more predictably in my retirement accounts. But I had a last straw moment in the corporate world, and I decided to leave as a result of it. I just got fed up in the situation I was in at the time. Now, for my own comfort level, I wouldn't have left unless I had like 2x coverage of cash flow to cost of living. That's just my own personal number, because if there were to be a downturn, then you have a little bit of padding, right? My personal full-time goal as an investor is to be at, like, to me, my ultimate number is 3x cost of living, because then you just like, you have so many different sources of income at that point, a lot of which won't get disrupted even in a pandemic, as proven, that you're going to be okay. That's my like ultimate benchmark of staying above that. What else? I tend to be very conservative. So some people would argue they only have to be at 1.5 times, 1.25 times. I could definitely see that. Even 1 times potentially, if you're able to scale back on your spending. But that's where I landed, and that's how I thought about it at the time. But again, it wasn't like a grand strategy to get out. It was more of a reaction to what was going on at the time. And I had that cash flow built up already. I didn't intend to try to live off of it. So I gave myself a 2-year test when I left, and figured I can jump back into the corporate world after if I had to.
Thank you.
No problem.
I was muted. Okay, Steve Sue.
Hey, Jeremy. Thanks for taking your time this evening to be with us. So I had a question, a couple of questions actually. So a little bit different, but do you have like a minimum cash on cash that you want to look at in terms of cash flow, since you are a cash flow investor in a deal? And then my other question is a little bit off the wall here, but I've heard you talk before about certain items in the PPM and the LLC document. So what are some of the important things that you look for in those things? Can you expand on some of those points?
Sure. Yeah. So for the minimum cash on cash question, it's a good question. So the way that I work through a cycle is that I try to establish a minimum year 1 target cash flow minimum projected net to investors, and a minimum 10-year average, say on the 10-year deal, average annualized projected cash flow net to investors. And if I can't hit that in a deal, then I typically try not to do it. And what I mean by that is the way that I try to keep myself out of trouble in a cycle, and how I actually landed at stopping to do most deals at the end of 2016 in this past cycle, was that each time an asset class gets too expensive and doesn't meet that criteria, I drop off the asset class unless it's a unique opportunity, and I just keep going on the other ones. And so in this last cycle, the last one that worked was mobile home parks, and that kind of went away at the end of 2016. My numbers for this past cycle are 9% cash flow year 1 and 11% average annualized cash flow. The challenge right now is that I can't answer that question yet for the next cycle, because we're in between cycles, and the Fed, and the government's been like delaying this cycle from starting. So in probably 2 years from now, I'm hoping to have an answer for you as to what that's going to be. And I'm going to suspect it's lower than the last targets, because interest rates have come down quite a lot over time. But that's how I work within a cycle. And I definitely have cash flow targets. That's a very important point for me, because everyone's got a limited amount of money to invest. And for me, especially because I live off the money, I've got to optimize it as best as possible. And there's so many deals out there that it doesn't make sense for me to do a deal that isn't going to hit my cash flow targets when I'm going to go on to the next one that does or can. So that's a very important metric for me. As far as the legal docs, so there's some basic stuff that I always look for, that some of it's probably going to seem obvious, but reporting requirements, cash distribution requirements, even indemnification clauses. I can get into detail about any single of these, but cash call provisions and how does it work, depreciation flow through? Are you getting 100% of your pro rata depreciation or not? You'd be surprised. You assume you're going to, but I've seen all kinds of stuff. Sometimes the operators like taking half of it just because they can, right? And you wouldn't even realize it necessarily. There's so many things, like if you pass, this is another one I always look for, you know, if I pass away, does it force me to sell my shares, or can my wife actually, even within a, you know, even if you're structured in a trust or whatnot, can she continue to benefit from the cash flow there, or is she forced to sell? There's a lot of agreements that force you to sell. And in the way that I'm set up, I certainly hope if I get hit by a bus tomorrow that my family is going to continue to get the cash flow, right? I don't want to be forced for her to sell and then have all this money she doesn't know what to do with. So there's a lot of things you can look for, a lot of important things. Are there voting requirements to sell? What does that look like? In the voting requirements, you know, does that exclude non-managing member members? Meaning, like, if you have to vote to get the manager out, but the vote includes the member shares or interests, and the way it's structured is that the manager in some cases owns 50%, just because that's the way they structure it, right? Because you can flow through payments of depreciation any way you want in an LLC. It doesn't have to reflect the ownership percentage. Sometimes it'll be almost impossible to vote the manager out, for example. And this is not necessarily, in most instances, I find that there's attorneys who aren't being thorough enough. Once in a while, there's something that's actually specifically put in there to what I would call overprotect, or be very adverse to the investors. So there's a lot of stuff to look for. The good news is that once you read enough of these, they become very cookie cutter, and you kind of know what to look for because they're all very similar regardless of the asset class, et cetera. Those are some of the more obvious ones that pop up immediately. I'm trying to think, you know, can a manager force anybody to withdraw at any time? Does it have to be for cause? Can you force a manager out for anything but cause? And if you sometimes you can't. Is there just a kind of majority vote just to get the manager out if there's a problem, right? Can the majority even vote to dissolve the company, which actually normally they can't. Normally you won't find it. And you have to remember, everything you're reading was put together by an attorney who was hired by the sponsor. And so the attorney's job is not to get the most balanced perspective for investors. It's to actually protect their client, which is the attorney, and try to make a somewhat reasonable set of documents for the investors too. So you really have to be careful with those.
Hey, Jeremy, I think when we first communicated, I told you it'd be 45 minutes, but we have a couple of more questions. Do you have another 5 minutes for us?
Yeah, go ahead. Yeah.
Okay, Paul, go ahead.
Thanks, Jeremy, for being here tonight. I was just curious, in follow up to what you mentioned about some of the items in the PPE that you may want to shine more light on. Have you had any instances that have come up that have been unexpected in investments, and where the investment has gone bad or there's been litigation? Sometimes you think those things can happen, but you don't think they can happen to you. So any experience with bad outcomes, I suppose?
Yes. So I have been in two, what I would say were either one was just outright fraud by one of the managing members, but it didn't cause a huge problem. We're in the middle of solving it. The other was mismanagement with the borderline fraud, which we ended up breaking even. So in the case of the mismanagement, I ended up negotiating with the manager, the sponsor, to leave and to provide us with all the assets. There's a pool of houses in exchange for not pursuing them. And then once we got a hold out of those houses, we got a new manager in, and then basically they liquidated everything within a couple of years, and we broke even. And break even to me after 5 years is a bad outcome because you've gotten no gain. You've lost money on the inflation, but it clearly could have been much worse. I'm in a deal right now where I've invested with a sponsor 20 times since 2002. And finally, all of a sudden, and this is lifelong friends of my family, one of the three partners, which was the father, actually was found to be taking a little bit of money out of the company over the years. And so the two sons had to report him, and we've had to go through all these steps of getting him out. He's not cooperating with the judge over all this. We don't know exactly where the money's gone. It's not a huge impact, thank God, because it's across like 11 properties, and we're having to switch the managers and get the loans assigned to the new managers, which, funny enough, switching the manager is quite easy. Getting the loans assigned to the managers across 11 different properties, 11 different lenders, just takes time, especially with COVID. So that's being ironed out. We're going to have lost a little bit of money that was in the reserves. That's where the money was being taken out of. There's no major damage. We haven't lost huge tenants. We haven't lost properties, that type of thing. I was in one property I've only been in one foreclosure this whole time in 19 years. And it was actually not even from like the downturn in 2008, 2009. It was just like one of those 1% risks. And in that case, I didn't even lose any equity because the operator actually felt really bad for everybody, and they're very high net worth. And they actually transferred everybody's money over to another property they owned. It took about a year. So I've been through, a whole number of different scenarios. And I think the most important thing, A, who you're betting on is always the most important thing. And B, is that if you can get properly diversified across operators, you're basically going to really greatly reduce your risk, in my opinion, because you're always giving control to somebody else. And that there's a lot, and besides like the fraud, mismanagement, and Ponzi scheme risk, then you have all these 1% risks of stuff that can go on wrong that you can never forecast, like the foreclosure thing I mentioned. So I've been through a few, but if you're targeting really low risk stuff like me, and you're going into a building that's 97% occupied in a strong demand area that's forecasted to be a strong demand area in terms of increasing in incomes and population size, et cetera, and jobs, and you've got a really experienced sponsor, you're in the way that I invest, the odds are stacked for you. And it's like an airplane, like, 5 dominoes have to fall before the whole plane crashes in a newer plane, right? Because of redundancy and all this stuff, it's kind of the same concept. Whereas if you go into a development deal, if one domino falls, the whole thing could go down the tubes, right? So that's one advantage I have, in that I'm investing in stuff that's going to be lower return, but has less probability of really blowing up as a result.
Thank you.
Yeah, no problem.
Okay, we're about there, so we're going to let Ryan Stieg ask the last question.
All right, Jeremy, in our forum right now, we have a really good discussion about liquidity and where we park cash. And you've been doing this for a really long time. Can you give us any insights on liquidity and balancing where you keep your cash while you're waiting for your next deal?
Yeah, so I remember in the early days, one of my biggest frustrations was like, I get 3 deals and I like them all, but I can only afford to go into one. That was really frustrating. So I tend to keep more cash on the sidelines than most people, probably just because I don't want to miss the deal. I'd rather not miss a good deal and get more diversified than lose a little bit on the returns of optimizing everything all the time. I have more cash than I like right now, certainly because I've been preparing for a downturn and stocking up on the cash, and now it's just taking longer to get through the downturn. And so in the meantime, what I'm doing is, besides high yield savings accounts, which really have come down a lot in the past 2-3 years, like really to almost meaningless numbers now, trying to find short-term ways for my money to work. So, the hard money can be good, because if you feel like you're okay for 6 to 12 months, which I wasn't last year, but now I do, then that could be a great source of income. As long as your loan to values are in check and really okay. I'm doing a little bit of this debt validation stuff that I don't recommend to anybody from risk profile perspective, but just to give you an idea, it doesn't even matter what it's called. It's more that like there's roughly like 100% return of capital in the first 12 to 14 months, right? And so to me, that's a great short-term use, really high IRR, even if there's a little bit of variation from the economy. And I'm kind of like compounding and snowballing, the snowball bigger. So that's appealing to me, because I think it'll probably hold through even if the economy goes down a little bit. But it's really tough, because I actually prefer to invest for the long term. That's what I like to do. I like to have more predictability on a 10-year locked loan, and I hate being in these short-term things, not the least of which is what am I going to do with the money in like 6 to 12 months from now, right? I don't want to have to worry about it again. But I'm trying to make sense of the current status of waiting, and trying to figure out things that can make sense in the meantime. And it's tough. It's really tough. I think that short of you just deciding you're going to go into some multifamily deals this year because you think they'll hold well, for example, as a generic statement, it's very tough to find it's very hard to find short-term opportunities in general in this type of investing. They're few and far between.
Excellent. Well, thank you, Jeremy. This has been just really awesome. We appreciate you coming out and meeting with us. We're going to stop here. For those of you that want to stick around, we're going to do some networking, and I'm going to pause for a few minutes and let people log off so I can get an idea of who wants to network. But Jeremy, obviously you're welcome to stay, but you've been here an hour, and we appreciate your time. So if you need to jump off, that's fine. Next month, I'm sorry, our meeting is March 22nd, 7 p.m., the fourth Monday of every month. And next month, we have Chris Raleigh, the CEO of Harvest Returns. So that's kind of a different asset class. It's different in every way. So it'll be something interesting that is not normal for us. So thank you again, Jeremy. We appreciate your time, and thank you for everyone being here. If you're here in another 2 minutes, we'll send you into breakout rooms. Otherwise, we will see you next month.
Thanks, Jane. Thanks everyone for showing up, and appreciate all the good questions. You guys were very active, which is very helpful. So I hope it was all helpful. That was really the whole point. So I hope it was helpful for the listeners.
Thanks,
It was
Jeremy.
great.
Yeah, thanks, Jeremy. That was great.
Thank you.
Thanks, Jeremy.
Okay,
Thank you.
have a good night.